Hello, this is Property Matters, a weekly catch-up on the world of property, supported by Fairview International Property Consultancy and auctionproperty.co.uk. And we're live every week on YouTube, Facebook, LinkedIn, and our website, propertymatterstv.co.uk. If you're watching on the website, leave us a Google review. And if you're watching on the socials, get involved in the conversation in the comments section below. Our email address for any discussion topics is hello@propertymatterstv.co.uk. There's a podcast version of the show every Monday morning at 10 a.m. And if you'd like to take part with that, then all you've got to do is to find it wherever you're getting your podcasts from on a weekly basis. So let's take a look at this week's property news with our property expert, Joe Joshi. Hi, Joe.
Yes, good morning, Paul. Good morning to all our viewers and listeners. Property market is forever evolving, and there's plenty to talk about of all the things that the new regime keeps bringing in or is trying to suggest.
Certainly plenty of change in property at the moment, and there's been a lot of talk in this last week about rent controls. Labour government has in fact ruled out rubber stamping powers for regional mayors to impose rent controls on private tenancies, according to a report. Speculation had surrounded the possibility of caps or freezes being introduced by the likes of the London Mayor Sadiq Khan. But according to the Evening Standard in the week, the government has said that it has no plans whatsoever to devolve rent control powers. The newspaper also quotes a spokesperson from the Ministry of Housing, Communities and Local Government as saying that there have been no conversations with the Mayor of London about introducing rent controls. Khan has in the past argued for a 2-year freeze on private rents in the capital, but the Evening Standard said a spokesperson for the mayor confirmed that no discussions have been held on the topic and added that rent controls were not currently a priority for Mr. Khan in his negotiations with ministers. So I wanted to broaden the topic out and take it further than London, because obviously we have a neighbour in Scotland who's had rent controls since 2022, I believe. And it's an interesting point, isn't it? Because obviously you would think, well, on the face of it, you'd think, yeah, that's a good idea because it's protecting those that are struggling to pay rents, and rents will be manageable. And there will be some kind of conscience in place to stop landlords ripping people off. But I'm guessing from what I read and from what you're going to tell me, they don't quite work like that, does it?
Yes, good morning. So look, the interesting subject for me and from my point of view, Paul, first of all, I find it really quite bizarre that anybody, London Mayor or anyone else, would like to impose rent controls on something that actually doesn't belong to them in any shape or form. People buy a buy-to-let property, they buy it as an investment, and the idea is that that's going to get the best return on their investment. And if that means getting the best market rent for their property, that's what they're going to go out there and do. And they're just not, there for the Mayor of London or any other mayor or any other person to direct them and give them a direction of what they can and they can't charge as a rent for their privately owned property. It's privately owned if it's cash paid outright, and it's privately owned because they have a mortgage on it. So it's the only other person that has any stake in that particular property is the lender, and of course the person that has taken the mortgage out. So I find it bizarre to think that there's ever even a strange thought in anyone's mind that, somebody can tell you what you can and you can't rent your property for. Imagine me coming to your place and saying, by the way, you're restricted only charging 1,500 quid when you think you can get 2.5 grand for yours, because that's what it is. Well, why would you want to do that? You might as well not have the asset. And it has two strings to that. One is, of course, it's your property and you should be able to charge what you like. And secondly, the more they impose such silly ideas that they come up with, more people in the buy-to-let market or in the rental market will walk away from it. And that means that there's a massive void, a massive hole in available properties for people who are willing to rent, who need to rent. And the government and all successive governments, including the ones before, and I'm pretty certain the one that's in the incumbent route now, are never going to really achieve these fantastic targets of building houses that they want to. So I believe that they actually are really not in a position to state that. And the sheer idea of somebody telling you that you can and can't do or increase their rent is just absurd to me. So from my point of view, I can't see where that would take them, where it would actually take the market, and what would potential landlords think if somebody was going to impose a limit on what you can rent a property for.
Well, from what I've been reading around and from experience of rent controls in other areas, there's a number of factors here. Firstly, landlords on the face of it go, well, if you're going to control my rent, I don't want to be doing it. So a lot of people back out and sell the properties. So that means there's less in the rental pool in the first place. And as
Yeah.
we've seen, a lot of those are being bought by first-time buyers now. So that means less rental properties. The other fact that I hadn't really accounted for was that when good landlords, of which the vast majority are, and let's not forget that because we keep hearing in the media that most landlords are evil, but the fact of the matter is that they actually invest, certainly between tenancies or even during, with new, say, white goods, or they might put in a nicer kitchen, or they will upgrade the flooring or the insulation or something. And because when they're making a profit, they see the opportunity to invest in that building to get a greater profit because they can put the rent up. So as a result of that, the property quality goes up. And of course, under rent controls, what happens is the property quality stays the same, but is wearing out and getting older, so therefore deteriorating. And the truth of the matter is that the investment in the property doesn't happen. And furthermore, the houses that are likely to be under a rent control are older houses which have a poorer EPC rating and so on. So the chances of then getting up to an EPCC and all the rest of it that we've been talking about for years is not going to happen. So the quality of the stock goes down, but at the same time, the number of properties reduces.
That's right. And the other thing that you got to pick up on that point, Paul, is that it's all very well imposing rent controls on other people's assets, private property, private buy-to-lets, private landlords. I mean, these authorities need to sort of look in the mirror for themselves and look at the rubbish that they actually rent out to existing people, and they've never maintained them, haven't got the money to maintain them. And if possible, where possible, they can get the best rent, they will get that rent. So what's good for the goose has got to be good for the gander, as far as I'm concerned. And I just don't think that councils or mayors or anyone else is in a position to be able to turn around and start to impose any sort of rent freezes, rent controls on something that doesn't belong to them. But they should do that to their own property, their own assets first, and prove, and like you said, prove and improve those assets by upgrading them and making them more lettable. Most people desperately don't want to rent from some of the council properties. And I've read articles, I'm sure you've read articles. I know of people that have gone in through that scenario where basically, moisture, damp, mold, all of these things are not just private landlords that do, but council properties that they own are in, disastrous order. And people turn around and say, I don't want to live here, and they have to rehouse them in another place. You've seen programs, you've seen them on the news, and that's council properties. So I can't see where anybody in their right frame of mind should be even thinking about imposing any kind of rent control.
Well, there is some rather damning statistics. There's a sort of lies, and damn statistics or something. But UK data from the Office of National Statistics, the ONS, released on the 17th of April this year, reveals that the largest increase in average rent since 2015 was, in fact, in Scotland, where they have rent controls. They've had them since September 2022, I was right, having increased more than any other country in the United Kingdom. ONS figures showed that during the year to March 24, average monthly rents in Scotland went up by more than in England. They went up by 9.1% in England, while rents rose by 10.5% to £947 per calendar month. Proof enough, says Good Lord, that rent control in Scotland has had the opposite effect from what the Scottish government says was intended. So what they had in place up until last year was, in fact, a process where you couldn't put the rents up mid-tenancy, but you could do it during voids or in breaks. But the law that is proposed, and that may well be reviewed now we have a new government, of course, but they're proposing, Joe, that actually a rent cannot be put up at any time without going to a tribunal to basically say, I want to put the rent up. And then it's a very complicated equation now, which is in place to do that. And that equation is the lowest of three different factors. And it comes down to a mathematical equation, which is incredibly complicated and just seems just too difficult and too much pressure. It just seems crazy.
No, it's bizarre. And to top that, who's going to pay for the cost of the tribunal? And who's going to actually fund that part of it for just proving a fact that the money that it takes to go to tribunal, get the legals involved, get all that paperwork done, all that time is also has a value, and that value has got to be taken out of the potential rental values or the increase of it. It's bizarre. I think the more they talk about this, the more they think about imposing, the more landlords we're likely to lose. That's my view on it.
Just wondering if I can show you that. That is the equation that they use.
Lovely. Yeah, it's very mathematical.
To work out the calculated amount of rent. So that's just one of the mathematical equations they use.
Yeah.
It just seems ridiculous, particularly when actually it's had the opposite effect. Rents have actually gone up. So that's an interesting story. So it doesn't look like we're going to get that in the UK, which is probably welcome news. Let's move on to a totally different topic. And this is one that we have covered briefly in the past, but not in great detail. And that's the furnished holiday lets, FHLs as they're known. The planned abolition of favourable tax treatment for furnished holiday lets, which was mentioned in the King's Speech, of course, from April next year, is prompting many owners to consider whether now might be the right term to sell or pass on their property to family members, according to the accounting giant BDO. On the 29th of July, the government published the draft legislation to abolish FHL tax regimes. Once enacted, this will mean that from the 6th of April next year, individuals operating those sorts of businesses will lose a number of key tax benefits. Currently, interest incurred on loans for the purpose of furnishing a holiday letting business are treated as a deduction from rental income in calculating taxable profits of the business. From the 6th of April next year, interest for businesses operated by individuals will cease to be an allowable deduction, and relief will instead be given as a 20% tax credit from the individual's tax liability. For 40 and 45% tax rate payers, this will mean a deduction in tax relief for the interest to the 20% rate. As trading assets, capital gains on the disposal of furnished holiday lets assets by individuals currently may qualify for business asset disposal relief, where they qualify gains up to the lifetime limit of 1 million would be taxed at a rate of 10%. As investment assets from the 6th of April, such gains will be subject to the CGT tax rate of 18%, so nearly double, for profits in the standard rate band, or 24% for profits in the higher rate band under current rates. If there's a change to the CGT rate announced in the autumn budget, which many suspect there will be, then these rates will increase. So I guess really what they're doing is bringing those that have moved into furnished holiday lets for these tax benefits. They're levelling up the playing field so that they punish them just as much as the landlords.
Yeah. I mean, look, again, here we are. It's a bit like being a motorist, isn't it, Paul? And it's the same as being a homeowner. Wherever possible, the big taxes are always going to be on things that everybody uses, and being a car person, as a good percentage of we always end up paying, congestion charges, ULEZ charges, road tax charges, and any other potential taxes that they can find, whether it's a company car, whether it's not a company car, whether it's an individual car, and so forth. And the same is applying here rapidly to the housing market. And during that journey, they are doing a grand job, whoever they are, to get all these landlords, that whether they're doing ordinary lets, a short hold tenancy, or holiday lets, to come out of that market because of these tax breaks being taken away or created. They've already done that damage on the buy-to-let market, which is why everybody wants to come out of it. And now this is another route. But what they don't understand is the more they start to tax these people and take them out, the less tax they're going to actually be getting in, because if people don't actually buy properties to rent as holiday homes or as rental properties, then there's not going to be much tax to collect on them, because they're just not going to be in that business. So I'm not really sure who's advising who here. But the reality is that, yes, these holiday lets, there may have been a loop, there may have been opportunity, and it's only a pocket full of the areas. It's not a holiday let that you're going to do in the middle of, I don't know, a big city town, because it's not there for as a holiday let. It's probably going to be Airbnb. And that might be that sort of, crossover of Airbnb and holiday let, short-term let, as opposed to it being on an AST long-term let. But the reality is that the holiday lets are mostly on coastal places, Devon, Dorset, that kind of area, where they've been arguing about where people have been buying properties up to rent out as holiday lets, and therefore starving the people that live there the opportunity to buy their own property, or first-time buyers. The truth be, it's a seasonal area, and not every young person wants to be living in the middle of Cornwall, when perhaps in the holiday season it's quite busy, but otherwise it's quite quiet. So they want to then move into places like London, and obviously enjoy the bright lights of the city and those things. So it's a real mixed bag of what they're going to do. But yes, of course, one of the things that does strike me in that conversation, and in your observation of this, is the CGT. And of course, that will, we're all confident that the Labour government in residence now has always made it quite clear that they want to tax more, and I think that's where we're going to end up with. There will be a higher rate of capital gains tax presented, because she's got to find the money to pay for all these other things that she keeps saying that she's got the money to pay. So, it's a vicious circle, but they are going to now talk the property people out of the property side. I don't think they'll do all of them up completely, because where it really causes a problem, Paul, is when people are borrowing money. That's where it becomes a real issue, because to borrow money, even at 5% plus a couple of percent on a buy to let, plus this, plus, people have got to return 10, 12% on their investment. And that is being not achieved at the moment. So that's not making it exciting for anyone to invest into the rental market. And those that have been in there long term, if they've got no mortgage on it, it's a good return. If they've got a mortgage on it, are getting out because the mortgage is costing more than what the income is.
BDO advised that if you have a FHL property and you're contemplating making capital improvements, you may wish to do that before the 5th of April next year, so that you can claim those capital allowances, because on the 6th they'll be gone. Only a deduction from profits for the cost of replacing domestic items will be available. And of course, what a lot of people do is they put those profits from their FHL into a pension. So tax relief for pension contributions by individuals is currently limited to contributions of higher of 3,600 or 100% of the net relevant earnings. Currently, profits from FHLs are treated as relevant earnings. BDO advises that from the 6th of April, therefore, these individuals who rely on profits of a furnished holiday letting business to support obtaining tax relief for their pension contributions may need to seek appropriate advice. So I guess really it's important to take proper advice in terms of this, because you have a number of options, don't you? You could continue on investing in the property. If you already own the property, you haven't got a mortgage to pay on it. And if you've got it let out for more than the 105 so 105 days out of 210 available for letting. So if you're part living in it, part renting it out, That's one consideration. But if it's a 365 days a year available property to let, and you've got it paid for, it's probably still providing you with a reasonable income, I would imagine.
Yes, like I said, if it's been paid for and there's no mortgage on it, then yes, it does provide a reasonable income. It's an offset. I mean, put it this way: if you've got a pension or you've got savings, then that particular property will do well. But if you've got a mortgage on it and it's a mortgage of 75% against loan to value, then you're paying out what you're bringing in as a lump sum towards a mortgage payment, and it's that mortgage payment that begins to make it difficult for people to continue in the rental market.
They say that one option would be to sell the property before the 5th of April, although the sale may qualify for business asset disposal relief. And even though the headline rate of tax is also now reduced to 24% compared to 28% in the prior tax year, the annual gains exemption has been reduced to $3,000. So it would be sensible to seek advice on your likely tax change before you complete the transaction. Remember that capital gains on property need to be reported and the tax paid within 60 days of completion. And that is a fact, isn't it? Because you have this with properties like, for example, in my situation, in a probate situation, you sell the property, you've got literally 2 months to get that tax bill paid. And of course, it can be significant.
Oh yes, and again, they want their money as soon as possible, but equally they are pushing out. My biggest concern is that there is a huge shortage of rental property, be it holiday let, be it ordinary buy rental property, private rental property for people to have the choice, and that has been reduced. And by being reduced, it's actually put the prices of those properties up because supply and demand factor kicked in. The supply is limited, the demand is huge for rental properties, so people are going to charge, much higher rates to rent those properties out. And that goes back to our previous story of where can they cap, or what's the point of capping something when basically they're not in a position to cap because there's not enough properties. So I think all of these are going in the wrong way around, dealing with what I think is a situation that feeds the economy, and that is the private rental sector.
They talk about the fact that you might be thinking about passing it on to a connected relative. In that case, it would be treated as disposal at market value. However, as a furnished holiday let property, it's a business asset. It may be possible to elect to hold over any capital gain on disposal to relatives. Of course, if they subsequently sold it, capital gains tax would be payable on any historic gains at the prevailing rate at the time, which could be higher than the 24% rate currently. In addition, the gift may have inheritance tax implications, particularly if you continue to use the property without paying rent. So consider the options carefully. It probably is a good time to take professional advice in these circumstances.
Yeah, I mean, look, because of that window of the 6th of April, or sorry, the 5th of April next year, a lot of decisions have got to be made. And if the 30th of October gives you the direction of what the capital gains tax is going to be, I would imagine a lot of people will start to think, well, actually, maybe it's time for me to get out and sell. And if they sell and they get out and pay their dues, then there's a reduction of available properties in the marketplace. So the government really needs to think seriously about what they tend to propose, and which would end up shooting themselves probably in the foot.
There's some difficult decisions ahead for FHL owners, that's for sure, because if you continue to let the property, it's also worth investigating whether to incorporate it into a company structure, which could be beneficial. While companies pay only 25% on the net profits and deductions for interest on borrowings can be more cost effective, there can be costs on setting the company up and transferring it into the company, and that could also have issues with any lenders involved. Equally, if you want to withdraw profits, there will be effectively 2 sets of taxes to pay, both personal, of course, and corporate. So incorporating a letting business needs very careful thought. Looks like they've got you whichever way you turn.
That's right. That's right. Well, that's like I said, whether they got you, whichever way they turn, they actually are shooting themselves in the foot a lot as well. They don't realize that, all of these changes will end up resulting with people thinking, well, I've got to go somewhere else. It's a bit like, you know, the mansion taxes and the big taxes for the people that are there is a hordes of people that I now speak to who are saying, well, actually, we're thinking about moving abroad, going somewhere else, and until things settle down because the taxations are going up too high. So, they've got to seriously think about what they're going to be doing. But I'm sure we'll keep a tab on it.
Indeed, we will. Final story of the week then. Nice, simple one, really. News that the National Residential Landlords Association, NALA, is in discussions with Housing Minister Matthew Pennycook regarding the proposed landlord database. It's a move that should be welcomed by many in the private rented sector, according to Phil Turtle, who's the landlord licensing and defence person. Turtle says the initiative could be a potential game changer, offering a more effective way to monitor the private rented sector and potentially ending the need for selective licensing schemes. He says that NALA should back his call for the government to adopt a property licensing model similar to that of Jersey, where the rental property licence costs just £60 for 2 years and all the necessary landlord documents are checked to ensure compliance with rules and laws. This, he says, would mean that landlords in England and Wales would need to provide valid gas safety certificates, detailed floor plans and other required documentation to receive a licence. A database that records all legally required documentation makes it harder for criminal landlords to operate, eliminating the need for selective licensing. What's your thoughts on this one then, Joe? You're smiling.
Yeah, it's how a go at landlord week by the sounds of things, Paul. That's why I was smiling, because whichever subject we've covered, they're not doing a grand job in trying to keep their landlord, and this is probably for our story today, and that's why I was laughing, a final nail in the coffin of database. And so what they're trying to do here really is get lots and lots of information about all those landlords that they think may be doing them correctly or not doing them correctly, so that for £60 they can actually log on and give them their information so that they can actually then target them as potential tax or other areas that they need to more reason for local authorities to go and put embargoes and suggestions of things that they haven't taken care of, like, for example, electric, gas certificates, some sort of protection, all of the things that they've now got to provide. And I just think that this is another way of creating a stealth tax. First, £60 potentially to give them the data, and then secondly, once they've got the data, for those councils to then go and attack those landlords and say, thank you for giving me your information, but by the way, you're not doing this right, you're not doing that, and now it's going to cost you this and going to cost you that. So it's just another way of the landlords saying, well, actually, you know what, that's enough. We're not going to do this anymore, and we want to get out. And of course, as we've spoken before, the institutional landlords will probably have this built in their whole infrastructure, their system. But the accidental landlords, the guys that have got their sort of 1, 2, 3 properties, are going to just think, well, do I really need the headache for all of this? And it's probably best for me to just say, you know what, I'm out, and I'll go and do something else with the things that we want to do. But so yeah, that's why I was smiling, because I just thought that this was a good story to sort of finish on the basis that you've got a final nail in the coffin for private renting landlords.
He makes a very good point here. He says most landlords' properties are not inspected regularly under the current scheme, and landlords face hefty fines for minor issues. Councils often overstep their authority, enforcing their own rules rather than the law. Reports from the Housing Ombudsman show that councils do not regularly inspect or care for their own properties either. Jersey's scheme offers better value, he says, checking documents every 2 years, which benefits tenants. The scheme applies to every rental property without any necessary complications. He's calling for the scrapping of selective licensing in favour of the Jersey model under the Labour government's proposed Renters' Right Bill. There's no justification, he says, for any selective licence to cost more than £60 for 2 years. If it does, it's either a money-raising scheme or the council for the council, or a sign of council inefficiency. It's a good point he makes, though, isn't it? Because they often get, because I presume they believe it's a vote win, or residents are going to be on the side. Coming down hard on the landlord's an easy win for the council, but they're not that strict on their own properties that they rent out.
Well, again, I brought that point out in our earlier discussion, and that is that, you know, their own properties, the council's own properties, don't meet the correct standards. So for someone to start looking at someone else and saying you're not doing it, they really need to look in the mirror and look at their own assets first before they start to put on these other pressures and compel people to, you know, do things that they're actually not doing themselves. So yeah, I think it's a great point of discussion and an interesting point for people that are listening and especially landlords to take on board and think, you know, do you really want to be part of such a database, and do you really want to be, you know, scrutinized to do your things when actually your local councils are probably not doing their own things, as is the case in a lot of councils. Most councils are near bankruptcy, so their argument is, well, we haven't got the money to do our things, but they've got the money to employ the people to go and pick on, you know, private landlords, because they can see that they may have the money. So yeah, it's a sector that's getting a lot of hammering, and I'm not really sure that they are doing the right thing, Paul, at all, especially when they've got, you know, targets as high as 1,500 homes sorry, 15,000 homes in the time that, you know, they're going to be in power, and maybe more, and they're not building them as quickly as they think they're like to, and I can't see that happening very quick.
No, one thing's for sure, we'll keep an eye on all of those stories. A bit of a landlord special this week, which is, we had a mortgage special last week, landlords this week. Who knows what it'll be next week, but we'll be back very shortly with another Property Matters.